In 1996, we bought an office building on Park Avenue. We held it for 21 years. This was an asset on Park Avenue, which was in the center of Manhattan. And no matter what was happening in the world, as long as you kept that great asset, it was going to be worth more. Over the years, we didn't have any secret sauce, and we had no strategy really when we started. It was based on a value thesis, and over the years we've tried to learn and develop a strategy that worked for us. We generally have always operated in a methodology where we're trying to walk away from the cliff, and we keep this slide in the office, in many of the offices in the world, to really indicate and remind all of our people that one should always look for opportunity away from where the crowd is going and not go with the crowd.
All engine running. Liftoff. We have a liftoff.
"15 or 20 years ago, we wrote down the investment guidelines that we had for the company. The first one is to identify places where we have a competitive advantage and invest in those areas. Second, always try to invest on a value basis. So go away from where the people are going and invest where other capital is not. And we found that's very important to investing in real assets. Third, what we're looking to do is to buy assets or find assets that have cash flow inherent in them, or we can build the cash flows within the business. So they may not have cash flow day one. You may have an office building and you may just have a piece of land, but inherently it's in a good place where you can build it to generate cash flow. Lastly, I guess we've always tried to adhere to the strategy that being contrarian and not being where the crowd is going is hard to do, but the most lucrative if accomplished. We always look at success on a total capital basis over the long term. And really that gets you staying away from short-term objectives within a company, which is often where companies make mistakes. Second, we always try to encourage all of our people to take calculated risks, but compare that risk with the return that one might get out of the investment. Third, we always look for the return over the longer term as opposed to the short term, and we'll sacrifice a short-term return to achieve long-term success. And lastly, we seek profitability rather than growth, because growth doesn't necessarily, in what we do, add value. Sometimes it does, but it doesn't necessarily add value. And as to business philosophy, we've tried to build the business across everything that we do and the relationships we have based on integrity. Because if you're going to endure over very long periods of time, you need to have strong relationships both outside the company and within the people within your business. And lastly, I guess the ethos within the company is to treat everyone's money like it's your own. And what we've tried to do with the business is try to make it very simple. And it really just boils down to 5 things. We try to use the global reach we have to acquire real assets on a value basis. Once we buy them, these are assets that can be easily financed with long-term capital that doesn't participate in the equity, and therefore the leverage to the return to the common equity owner is significant as long as you do it properly. Third, we then try to take the people that we have in the business and enhance the cash flows through using all those people and the operating platforms we have to grow them. The equity we find, we get from our institutional and other clients globally, and we look to continue to grow and buy real estate and infrastructure assets with that capital. And then we just do this over and over again. And generally, we're very long-term in nature and often own assets much longer than other people. All the assets we own and buy are of similar cash flow characteristics. 4 characteristics we think can be very helpful. As I said, size does not necessarily generate profitability. But given the scale that we have, we've been able to use size as a differentiator. And today, given the size of the organization that we have and the size of capital that we have to put to work, there are often only 1 or 2 other people in the world that someone can bring a transaction to. That gives us a competitive advantage. And if we can use the other advantages we have, it differentiates our money versus others. Second, over the last 20 years, we've built a global business. Very few other investors like us have as large of global business as we have, and that's allowed us to move capital to where we can best find the opportunities. 2 years ago, that was in Brazil. Recently, it's been in India. In 2009, it was in the United States. That global platform allows us to take ideas and turn them into actionable opportunities. If you don't have a global platform, you can't do that. 3, most of the capital we have has limited restrictions on it. Therefore, we can invest. We're agnostic to the opportunity type, the form of investment, whether it's a public company, a private investment, or some other, a convertible debenture or common equity. We're agnostic to that. Often people have restrictions on the way they invest, and if you can be more agnostic to that, it's helpful to the long-term returns. And lastly, our operating businesses give us a strategic advantage to be able to run the businesses and operate the things once we're there. This generally enables one to find value investments no matter what the environment is. And often in countries, for example, in the United States, stock markets are at their high, bond markets are at their high, and often one would say it's tough to find opportunity within that environment. And to some degree, that's true. But if you can use your advantages to be able to find opportunities within that sector, you should be able to continue to invest despite the environment in a country. And there's a few reasons for that. Often our investments are longer term and are more illiquid than others. So our advantage is that we're willing to be longer term investor and we're willing to have something that's illiquid versus what others might accept. Often they're larger in size, and that's not attainable by others. Often they're not easily acquired, It's tough work to do it, syndicated or operated by people. We bought a pipeline in Brazil 2.5 years ago. That pipeline is a major infrastructure asset in the country. Not everyone can run a large pipeline in Brazil. Often these investments are seen as risky if you're not intimately involved in them, which is a strategic advantage if you do operate the type of assets. They require skilled people to operate them. And most of the time when we're making investments, it's not fashionable. Most investors follow fashion. If you cannot follow fashion and follow value, the returns will be much greater over the longer term. Sometimes you can have capital and you think it's a good opportunity. If you can't find equity to be able to invest, these real assets, being real estate and infrastructure, have a strong return profile for people to invest into. And there's just a few reasons for that. One, they generally earn good cash-on-cash yields. Two, they generally can be contracted for long durations, so you have security of cash flow and often increases over time. Sometimes that by inflation and sometimes by other means. Fourth, often these assets are scarce. And as many of you know from living in cities, the world is urbanizing. And what it means is the value of real estate in city centers is getting more valuable every day. And that means assets appreciate in value. The private nature of them for pension plans, institutional investors, allows the volatility to be low. So they're not looking at the stock market return in their portfolio going up and down every day. And the returns are generally far greater than other options available to investors. The first one is, if we can find great assets, we should always buy great assets. And if one has to pay a little more for great assets, that's okay, but make sure you buy quality. Don't do it at any price, because price is always important. As I stated earlier, go away from the trend and try to buy value. You can buy great assets, especially during distressed times. Just a short example, in 1996, we bought an office building on Park Avenue. We paid $432 million for it. We've been through 4 cycles since then, which included 9/11 and the financial collapse of 2008. We sold this asset for $2.2 billion last year. So we held it for 21 years. For 10 years, we've had no money in it, meaning we financed all our capital out. In the end, we had a $900 million mortgage on it. So we had financed out our original investment plus another $500 million. But this was an asset on Park Avenue, which was in the center of Manhattan. And no matter what was happening in the world, as long as, in the fullness of time, as long as you kept that great asset, it was going to be worth more. And there were times when it was tough to own it, and cash flows didn't look so good, but a great asset in a city could be paid up for a little bit during a period of stress, which we bought it during a period of stress in 1996. Second, we try to invest assuming that we're going to own the assets forever. Now, that last asset I showed you, we owned for 21 years. In most people's investing principles, that is forever. But we try to buy everything that will own it forever. And the most important point there is, if you're buying it and going to own it forever, you look at it with the long-term fundamentals involved, not what's going to happen to it next month or whether it will trade up in the stock market. It's that you may have to own it forever. And even though we may not own it forever.